Let's go.
Ready?
Yeah.
All right. Thanks for joining us today. We're excited. We've got an iHOP opportunity in the state of Texas, one of the new places we've been looking to buy and acquire properties at. So we're excited about that.
Yeah, iHOP, first brand we've ever done. It's the first iHOP we've done, and second property in Texas. So we're continuing our expansion in Texas right now.
But it's second property, but also a little bit of the same group, because we've got an Applebee's that we purchased in Killeen, Texas, and now this iHOP is located north of Houston. But you may be wondering, why are we interested in iHOP as a brand overall?
Well, first of all, iHOP and Applebee's are owned by one parent company called Dine Brands. It used to be called Dine Equity. So it's publicly traded on the New York Stock Exchange. It's DIN, if you want to go look it up. And they, of all the brands, you like to follow brands, of all the brands that have had a good COVID recovery, Applebee's and iHOP are one of those brands. They're coming out of it stronger than they were before, and their sales are actually now going beyond pre-COVID numbers.
Yeah. And we've seen that a lot when we looked at brands that went through COVID and they kind of used that as an opportunity to cut some underperforming locations and then really focus on the strong performing locations. And now we're seeing brand expansion. So all of the brands that we've invested in, whether it's an Applebee's or a Dollar General or an iHOP, we're looking at brands that not only came through the past couple of years, but are now looking to continue to expand. And iHOP, they're looking to add about 80 locations going forwards. They're stepping it up. They were kind of doing 40 locations a year.
They were doing 40 a year for a long time, and then COVID, of course, they had a little bit of a stop, but now they're going back strong. And I think the last thing we read is they want to do 80 units in 2023, correct?
Yep.
Okay.
That's what we're seeing. So we look at a brand and we see iHOP, where we have a very well-known brand operated by a big operator that we have experience with. So Argon Capital out of Atlanta here, they're the ones that are the operator of this, and they operate over 300 iHOPs. But they have a lot, and then they have 120 Applebee's, and they operate in numerous brands.
Yeah. So 400, just in the iHOP and Applebee's brand, they're over 400 units. I mean, Argon Capital also operates other brands. We looked like Planet Fitness, Sonny's Barbecue, John Deere.
Yeah.
So they have a whole wealth of...
They're all franchise operations that they're doing.
Right.
So
on the border Mexican too.
That's a good place. Yeah. But so we look at iHOP, we have a growing brand that we like, and we have a strong operator that we've worked with before. That's why we like the opportunity that we're seeing with iHOP, but then we've got to dig in into this location specifically and say, okay, what's the story here, and what is the opportunity that we see with the iHOP in Houston?
Yeah. So, we're in Spring, Texas now, which is just north of Houston. It's equivalent to, if you're in Atlanta, it's equivalent to like Alpharetta versus the city of Atlanta. So you're just in the north part of Houston. Arguably, the nicer part of Houston is what I hear. Is that a good assumption?
Well, Houston's got about 20 million people in the MSA, so I think there's lots of variability in that market. But This is a great purchase. It's exactly what we want to do right now. It's a short lease. We're buying it for $3.8 million. It's got 2 years left on the lease. We're going to extend it, and we're going to basically sell it within a year or two. So it's going to be a very short-term hold. This is going to be counterintuitive, but our business plan is to buy it. Its rent is a little bit high right now because of for whatever reason. Well, we look at rent, it's high because we're looking at rent to sales ratios.
Right, we're looking at rent to sales, and so the rent to sales ratio is high. But okay, you ready for this, Dave? We're going to lower the rent and sell it for more money. Counterintuitive, right?
Well, it depends. We got a short-term lease. So we look at this deal.
Lease, yes.
We're looking at an acquisition price around $3.8 million. And with that, the lease only goes until 2024. So for most buyers of net lease assets, they're looking for long-term cash flow. And here, we only have an in-place lease until October of 2024. So right about 2 years. And by the time we actually close, it'll be under 2 years that the lease is good for.
And why do we know that they're going to renew their lease? First of all, we know their sales. They produce about $2.3 million a year. $2.3 million a year for iHOP is pretty good. If you look at all the average unit volume of the iHOP portfolio across its 3,000 plus restaurants, this is 130% of what an average iHOP does. So it's an above average iHOP. It does very well, and it makes money. And so how do we know they're going to renew their lease at the end of this term? We do, because their sales are in line, it makes money. And quite frankly, we've called the real
We've
estate
worked
person.
with the operators before.
Yeah, we know their operators. Their phone numbers in my phone. I call them and say, hey, what are we doing with this? And we talk about it. And what does a lease extension look like for this one? And we have all these discussions before we close. And we have a really good idea what's going to happen after we close.
And that, if you've tuned into some of our other live streams we've done, we've talked about the Placer AI and the location-based data that we're using. And that's one thing here, when we know their store sales are good, and then we can also see their foot traffic is good compared to other locations. And we know they went through and kind of cleared out any locations that were underperforming. That makes us very confident that we know.
Right, and we validated everything there is to validate. We validated sales, we validated foot traffic, so the foot traffic data follows the sales data, and so we know this is a good location, this is a performing location. There is nothing about this location that says, there's no red flags about the business of this location. It's a good location, a good business and a good location, and it's going to meet all of our metrics for our purchase.
When we look at the sales and the lease comps for this asset, we're looking at other iHOP locations that have either been sold or have a lease that was renewed or a price point that we can relate to. And we see here most of these assets are trading in the 5 to 6 cap range. Right. And that's changed a little bit with the current debt markets. As debts become more expensive, we're seeing changes in cap rates, but these things are still, with a long-term lease in place, we're seeing very strong cap rates.
So yeah, I mean, so if a longer lease will probably trade someplace in the 5s, so a 5 cap, something. And then, maybe a 10-year lease or something like that would probably sell like in a 6 or just above a 6. And we're buying for above a 7 right now. And this one gets 1.25% rent increases, 1.25% rent increases every year. And so every year your rent is increasing, which also increases your sales price if the cap rate stays the same. Right. And so, this is what I'm talking about as far as it being counterintuitive. We're going to lower rent, but we're going to also raise the sale price because the cap rate's going to go down significantly. And so even though we're lowering rent, we're going to buy it at a 7-something cap rate and then sell it at maybe a 6 cap rate. So we have a whole point spread between the two, and we'll be able to make money on that spread.
And we plan to execute that as quickly as we can, really.
Right. This will be a short-term hold. It'll be a year, maybe 2 years. So we're planning on at least holding it a year. So we do the long-term capital gains. And if we get a great price for it, we'd sell it. But current plan is to hold it a year minimum, maybe 2. And then exit and sell it at a market cap rate for the lease term that we have.
Yeah. So our investment overview as a whole, I mentioned we're paying $3.8 million for the assets. We have some reserves and we have our closing costs in here, but there are no upfront CapEx needs for this asset. So you see that as a 0 on our acquisition schedule here.
And a lot of these franchisees already have CapEx baked into their lease since they're triple net leases. So one of the questions I asked them is, hey, do you want some CapEx? Do you want some capital to us to donate to get an extended lease term? He said, no, we already have that baked in. All they really want is a rent adjustment. And so that's the only obligation we're going to have. And hopefully we'll do the rent adjustment, honestly, after our term we own it. So the cash flow won't even be affected during our term of ownership.
Yeah, it's a great opportunity for them and good for us as well.
Yeah, it works both ways.
Position. Yeah. We look at our year 1 and year 2 cash flow, and a lot of the times on this side of our investment overview, we're talking about maybe year 1 and year 5, or year 1 and an exit year. And in here, we only have 2 because our time frame that we spoke about is only out for 2 years on holding this asset. So we're looking at what we're going in right now and our projected NOI, and then we're also looking at what we're just exiting for going into year 2.
So it's a great short-term deal. So if you ever wanted to get into a deal and you don't want to put your money up front someplace for 5 years,
this one is going to be...
This is going to be your deal.
It'll be under 2, and with that, we see an IRR that's in the mid-teens now because of realizing the cap rate compression and then exiting in the shorter time frame.
I think minimum we were looking at right now, we model is about 15 to 16%. And as we get... if we get the cap rate in the 5s as far as the sale price, then we're getting into the 20 to 25% overall return on the project, which is pretty good. That's pretty good.
Yeah, no, I mean,
I take that all
over
day.
20% would be excellent.
I would take 15% for the rest of my life.
But our target on this one is, our target is 15 for an IRR of what we're looking at here. So just overall performance, again, we mentioned why we're bullish on the iHOP location and iHOP brand, and specifically this location. We mentioned Placer. We see we're in the top 70% of all iHOP locations in the U.S. that we have foot traffic data on. And in Texas, we're right in the middle. So Texas is a pretty strong market from overall sales volume on a per store basis. And nationally, this iHOP is a very strong performer.
And remember, we talked a little bit about average unit volume for sales, and this one produces about 2.3 million, remember. And an average Applebee's, you know how much an average Applebee's earns?
An average Applebee's or an average IHOP?
I'm sorry, I'm getting confused. Brand collapse. Average IHOP.
Wow. What do you think we're at?
Well, we're at 2.3, but what do you think the average is?
Well, I know it's 130%.
So if you do your math in your head, it's about 1.8 million. So an average IHOP is about 1.8 million.
Yeah, so, but that's also Texas is a strong market. And all the store sales there are pretty high. So
Right.
it's good.
Texas is going to be a high volume store. I mean, it's going to be it's a big city. So a lot of these big city IHOPs are going to be better than AUV. But honestly, you know, sometimes they're not, because sometimes when they're in a big city, they have a lot of competition. So, you know, down the street, there could be a Cracker Barrel competing with it or some other competition. But this one is in a big city doing really well. And the visibility of this location is as good as it gets.
It's right off the highway.
Literally.
On a giant highway.
Yeah,
not
it's on a giant highway. You look to the right when you're driving up the highway, or the left, and then, oh, look, there's IHOP. And, oh, let me get off the next exit and go to IHOP for breakfast. Yeah. It's as good as it gets.
Yeah. So overall cash flow, overall returns, we mentioned our target IRR of 15.8%. That's what we're looking at when we say we're going to acquire, we're going to extend the lease, and then we're going to exit underneath that 2-year time frame, and that is what we're targeting. We have some sense of some variability into what the returns could look like if cap rates are higher or lower, but a lot of that has to do with the market, but that also has to do with the lease that we sign.
Right, because we model the worst case rent discount.
10-year or a 15-year lease will change what our exit cap rates could be too.
Correct.
So, okay. That's it for this iHOP. We are excited about the brand. We always love investing with brands that are growing and operators that we know. We're going to be bringing out more information on this one in the coming weeks here, and we are excited about getting this deal launched and bringing it into the Greenleaf portfolio. Thanks for watching, everyone.